Hi, I'm Mike Gassewitz, CEO of IAIC. Welcome to another episode of In Focus. Joining me today is Joel Baker, our Chief Investment Officer. Welcome, Joel.
Thank you, Mike. How are you
Great to
today?
have you. Oh, doing great.
Good.
Today we have a good session, a good topic, real estate. Well, real estate first of all, and then specifically REITs, real estate investment trusts. And I always love talking about real estate because pretty much everybody, once they get into their working, they're dealing with real estate in one way, either renting or purchasing. But a lot of obviously our clients have real estate as an asset, so it's something very tangible. And obviously, it's been pretty prevalent in the news in terms of just coverage of REITs and specifically coverage of real estate in general. The pandemic definitely had its play. Some interesting takes in terms of what happened from a residential real estate perspective, but then also impact when it came to office space, for example, and even probably pre-pandemic, what was happening on the retail space. And so we thought it'd be good to talk about REITs in general. So thanks again, Joel, for joining us.
Yeah, sure. Those are all great points, Mike. And to your point exactly about real estate, everyone seems to have examples of real estate, whether it be their house or investments or outside other investments. So yeah, it's a common discussion point with clients for sure. So it's very, very timely. So yeah.
So why don't we let's start with the basics. Just make sure everyone's on the same footing. What is a REIT?
Yeah, great question. So REIT basically is an entity that owns or operates income generating properties. It's simply as that, Mike. So in a nutshell, it's basically a way that investors like you and I can participate in earning some of this income from real estate without us having to purchase the actual properties, which can, as you can imagine, can be pretty expensive. So it's just a way that we can all sort of participate in through the REIT structure in real estate investments, but not own the actual assets ourselves. And drilling down, there's really two ways to do it. You can sort of buy it from publicly traded REITs or privately traded REITs. So again, for our purpose, we like the liquidity aspect. So we buy those that are traded on a registered stock exchange like the TSX. But there's a lot of good ones out there too, that if someone wants to buy those privately held REITs, you have to purchase them right through the issuers themselves. And so sometimes there can be a component that you can't get your funds back out for, say, a certain X amount of time. So it could be a year, it could be 6 months, or it could be a valuation or something like that. So obviously liquidity is very, very important for us. So we like the publicly traded vehicles. And even to go one step further, Mike, is kind of two definitions. One is, traditionally they call it equity REITs. And those are, most people would think of as bricks and mortar type investments. Whether it be retirement homes or apartments, shopping centers, as you said, is a good one. Warehouses is a recent one too, so it's very, very, very popular. The other side of it is more like financing vehicles, so mortgage REITs, whether it be mortgages, mortgage-backed securities, other financing vehicles. So those are more like the mortgage REITs as opposed to the equity REITs. So
Right.
two distinct kinds. Yeah.
That's a great breakdown. So from our perspective, what's our strategy when it comes to REITs for our clients?
Yeah, for the most part, we like them from the income generating aspects, Mike, that we just mentioned. So it's nice to get the unit prices going up 1 or 2%, something like that. But for the most part, we buy them for yield. And it's really designed to complement our bonds and preferred shares in the portfolio. So we sort of sprinkle them in as that income generating asset or income producing asset. And it's just a way to kind of guard against any sort of interest rate spooks or interest rate surprises. So we sort of sprinkle them in. We kind of collar it that we only purchase X amount of the income producing investments into REITs, but it's sort of a yield play for sure in terms of putting them in the portfolio. And then even drilling down, we always talk quality. So we try and buy what we feel might to be quality names and own quality properties. They're big, broad, diversified kind of REITs that, they kind of carry out their own diversification strategies within the REITs. So we kind of have that extra coverage as well. So big, broad, blue chip kind of names.
Okay, so even the REITs themselves have diversification within them in terms of their property types.
Exactly.
Okay.
Yeah.
So lots been, again, I mentioned it, you mentioned, look, on the office exposure side of things, it's always in the headlines. People still aren't returning back to work the way it happened pre-pandemic. And so what's our exposure from that perspective?
Yeah, you hit it spot on, Mike. So yeah, the latest trend that I always sort of joke that investors love to hate these days is commercial real estate, and particularly in the U.S. commercial real estate. So that's sort of the trend now in the headlines that people love to hate. And the big component is exactly what you just hit on: office exposure, and no surprise to anyone, it's a result of working from home as a result of COVID. And now that we're opening back up again, it's firms just like ours figuring out what we need as far as real estate to have office exposure and people back in the office. So as all of those things are getting factored in and figured out, office is in the headlines for that angle. So again, when we drill down and look at our names to kind of answer your specific question, Mike, we're about 9% exposure to the offices. So it's not a big number, but it's not zero either. So to put it in perspective, now again, most of the REITs that we hold own properties that people are sought after, as far as offices wanting to be in certain buildings. But like everything, there's AAA kind of properties, and there's lower tiered properties. So there's going to be a little bit of spectrum of there that are always in demand, but definitely in the headlines for sure. So not a big number, but not zero. So that's kind of what our exposure is.
So right now, then, can you give us a feel for what kind of yields we're seeing from the REITs in our portfolio?
Yeah, exactly. If we looked at the distribution yield, Mike, they're about 6.11% is the actual number. So just a little bit over 6%. But maybe just to drill into the REITs a little bit more from a taxation angle, because I think this is important to know as investors. They're designed to pay out a large percentage of their cash flow. So for example, a real estate, in order to keep its REIT status, has to pay out 90% of the cash flow to unit holders. So that's important, that they're not really taxed at the corporate entity like a typical blue chip sort of equity is. They flow it out to us as investors. And as a result of that, we then get taxed as a unit holder. So we get those various forms of taxation on our distributions. So whether that be a return of capital component or an actual dividend, or it can even be capital gains if the REIT sells some property. So it's a much more tax efficient form of income than comparing to other sorts of traditional dividend paying sources. So it's a little bit in the weeds from a taxation perspective, but it's important to know. But if you actually look at the number, though, it's just a little bit over 6% as far as a yield comparison to compare to bonds and preferred shares.
Okay, and it's good to know to understand the tax handling of this as well. Sounds pretty advantageous.
Mm-hmm. Yeah.
So the outlook, what are we looking, as we look forward in the next year or two?
Yeah. REITs, for the most part, Mike, REITs are subject to some of the same things that typical companies are, or typical investments are, and really what I'm referring to there is, one is increasing interest rates. That seems to affect everything, and REITs are no exception to that, Mike. They're having to increase their financing costs, or either renewing their mortgages or just issuing new debt that is sort of affected by higher rates. Now, the good news about that is REITs can typically pass that on to their tenants. So again, it's sort of a flow through. So that's one, maybe a benefit to a REIT where an ordinary company can't do it quite as easily. And the other angle is, as bonds have come back in yields, if we're comparing that 6.11% yield to a bond of, say, 5%, it's not quite that disparity of comparing a year ago to a 2% bond world to 6.11. So again, there's a little bit of that as well from a comparative perspective that's hitting the yield component of REITs right now. The other thing is property values. So again, some of the REITs are having to do some write downs on their properties. Again, the REITs are a little bit different beast here, because that actually hits earnings, where for the most part, as investors, we're worried about cash flow. So it's kind of a non-existent charge that affects earnings, but not cash flow.
Yeah.
And again, back
more
to that
the
9% cash flow. Yeah.
More the P&L versus the
Exactly.
cash flow.
Exactly. So again, what we're finding is a lot of the REITs, the two components right now that are doing very, very strong in REITs are residential and industrial. And those are our two biggest concentrations in our names. And like I was saying before, Mike, even the REITs themselves are transitioning towards that. So the REITs are getting more and more exposure to residential properties. And so again, it's just an added benefit of that diversification strategy. So yeah, it's a way to complement, like I said, the income generating component. we're maybe increasing the exposure, but not making big bets. So we're kind of just tweaking it to be a little bit higher as part of that income producing exposure, but not making big bets. Just until the clouds are a little less gray in some of those areas. But
makes sense. Okay, Joel, thanks for this.
Okay, anytime.
Folks, as always, if you have any questions, feel free to reach out to your accounting firm, investment financial advisor, or as always, talk to your portfolio manager, or feel free to reach out to myself. Take care, everyone.